All right. Hello, everyone. I'm Aaron Sachs, manager in our nonprofit team. I want to welcome you to today's nonprofit roundtable, the 2022 annual GAAP update for not-for-profit organizations. Today, we'll have the privilege of hearing from a few members of our nonprofit team. We'll be sharing best practices and requirements for ensuring compliance with reporting standards. We'll walk through the recent updates to US GAAP impacting not-for-profit organizations. First, a little bit about Jones Roth's history. Jones Roth has been serving clients in the Pacific Northwest for over 75 years. We have 3 offices across Oregon and about 100 employees. Our team is niche focused, which allows us to specialize in industries to serve our clients with a level of expertise of a large firm with the service and staff continuity of a local firm. Our nonprofit niche team is one of the largest niche teams in the firm. We have a diverse team of CPAs and business advisors that is dedicated to serving our nonprofit clients. Now I'd like to introduce you to our presenters today. Thank you.
Thanks, Aaron. Hi, everybody. My name is Carrie Young. I'm a partner in our Eugene office, and I help lead our nonprofit and affordable housing teams. And I'm really glad you could all be here with us today.
Hi, my name is Matt Currier. I'm a manager in the Eugene office, and I'm also on the nonprofit and affordable housing niches.
Hi, I'm Siobhan Lewis. I'm a manager in the Bend office, and I'm also in the nonprofit niche team. We are happy that you are here with us today. For today's presentation, we will be reviewing the new lease accounting standard, providing an overview of the revenue recognition principles for not-for-profit entities, discussing the new accounting standard for non-financial assets, and if we have time, we have summarized some of the other key financial reporting considerations for not-for-profit organizations. We'll have some time at the end for a Q&A, so please feel free to submit questions in the webinar control chat panel throughout the presentation. We have a team member monitoring those questions, and we'll try to address them at the end. If we don't get to your question, feel free to reach out to us after the presentation. We're going to start off with discussing the new leasing standard. The new leasing standard will bring complexities within your lease accounting process. It is recommended that you contact your CPA as soon as possible to assess what impact this new standard will have on your current and future leases. For the purpose of this presentation, we will be using a simplified example to illustrate the changes. The purpose of the updated accounting standard is to increase the transparency and comparability among organizations by recognizing a lease asset and lease liability on the balance sheet and disclosing key information about leasing arrangements. The main difference between previous GAAP and the updated standard is the recognition of a lease asset and lease liability by the lessee for those leases classified as an operating lease under previous GAAP. Because applying the new lease standard results in new lease assets and liabilities in the financial statements, nonprofit organizations with debt will need to assess the effects of those new assets and liabilities on debt covenants. It is necessary to make a rough estimate of the effects of implementation on financial covenants as soon as possible, and then stress test those covenants to see how sensitive they are to changes that might occur, such as decrease in pledges or the signing of a new lease. It may be necessary to talk to your lenders about adjusting the covenants for new standards, and it is best to do so as soon as possible. For most nonprofit organizations, determining the effort necessary to implement the standard requires locating all of your leases. The effective date for all entities is fiscal years beginning after December 15th, 2021. That means entities with a 12/31/2022, 6/30/2023, and 9/30/2023 year end will implement this new standard from the start of the financial year. Early implementation is permitted. Looking at the lessor perspective, there were no significant changes stemming from the new lease standard. Existing lease classifications are retained: your sales type, direct financing, and operating leases. A vast majority of the operating leases should remain classified as operating leases, and lessor should continue to recognize income on a generally straight-line basis over the term of the lease. There are some modifications to align with revenue recognition guidance under ASC 606. Since there weren't any significant changes from the lessor perspective, we will focus on the perspective of the lessee. All leases, both financing and operating, creates an asset and a liability for the lessee, and therefore recognition of those lease assets and lease liabilities represents an improvement over previous GAAP, which did not require lease assets and lease liabilities to be recognized for most leases. There is an exception for leases with a term of 12 months or less, in which the lessee is permitted to make an accounting policy election by class of an underlying asset and not recognize the lease asset or lease liability. The lessee would then recognize a lease expense over the term of the lease. This exception does not apply to cases in which the organization is reasonably certain to exercise the option to extend the lease beyond the 12-month term. Lessees are required to report on the statement of financial position, a right of use asset, and a lease liability. The new change indicates the nature of the lease. The lessee has the right to use the asset and a liability to make payments under the terms of the lease. Lessees will be required to classify all of their leases as either a finance lease, which is similar to the former capital lease determination process, or an operating lease. A lessee shall classify a lease as a finance lease, and a lessor shall classify a lease as a sales type lease when any of the following criteria are met at the lease commencement date. The lease transfers ownership of the underlying asset to the lessee by the end of the lease, or the lease grants the lessee an option to purchase the underlying asset that the lessee is reasonably certain to exercise, or the lease term is for the major part of the economic life of the underlying asset. However, if at the commencement date falls at or near the end of the economic life of the underlying asset, this criterion shall not be used for the purposes of classifying the lease. Guidance suggests using 75% of the economic life. And lastly, the present value of the sum of the lease payments and any residual value guaranteed by the lessee that is not already reflected in the lease payment equals to or exceeds substantially all of the fair value of the underlying asset. Guidance suggests using 90% or more of the fair value as a threshold for substantially all of the fair value of the asset. If none of these are met, then it is an operating lease. One must differentiate between financing leases and operating leases because there are some differences in reporting. For a finance lease, you will recognize the right of use of asset and the lease liability initially measured at the present value of the lease payments. You will then recognize interest on the lease liability separately from the amortization of the right of use asset. And you will classify the repayments of the principal portion of the lease liability within the financing activities and payments of interest on the lease liability and variable lease payments within the operating activities in the statement of cash flows. For operating leases, you will recognize a right of use asset and a lease liability, initially recognized at the present value of the lease payments. You'll recognize a single lease cost calculated so that the cost of the lease is allocated over the term of the lease on a generally straight line basis. And you'll classify all cash payments within the operating activities of the statement of cash flows. The rate to be used when determining the present value of the lease payment is your implicit rate of the lessor, or if the implicit rate is not determinable, the lessee's incremental borrowing rate for a similar collateralized loan in a similar economic environment, or the risk-free rate may be used if the election is made. A portfolio approach may be used to establish your discount rate. The lessee may determine the discount rate for the lease for individual leases entered into different dates throughout the current period by using a portfolio approach. That is, for example, a lessee can apply a single discount rate to a portfolio of new leases. This is because during the period, new leases are of similar terms and the lessee's credit rating and the interest rate environment is stable. We're now going to look at a lease accounting example. A lessee enters into a 10-year lease of an asset. Lease payments are $50,000 per year, all payable at the beginning of each year. The rate implicit in the lease is not readily determinable. The lessee's incremental borrowing rate is 5.87%, which reflects the fixed rate at which the lessee can borrow a similar amount in the same currency for the same term and with similar collateral as the lease at the commencement date. The lessee makes lease payments for the first year of $50,000 and measures the lease liability at the present value of the remaining 9 payments of $50,000, discounted at the rate of 5.87%, which is $342,017. The lessee also measures the right of use asset of $392,017, which is the initial measurement of your lease liability plus the lease payment for the first year. Looking at the journal entry at the commencement of the lease, you will debit the ROU asset and credit the lease liability for the amount of $392,017. You will then record the initial payment of the lease by debiting your lease liability of $50,000 and crediting cash. Next, one will determine the classification of a lease. Is it a finance lease or an operating lease? We will be using the same fact pattern to illustrate the differences between operating leases and financing leases. We're first going to look at a finance lease assumption. Looking at the amortization table, the lessee depreciates its own assets on a straight line basis. Therefore, the ROU asset will be amortized on a straight line basis over the 10-year lease term. The lease liability is increased to reflect the year 1 interest on the lease liability in accordance with the interest method. In year 1 of the lease, ABC Nonprofit recognizes the amortization expense of $39,202, which is the initial value of the ROU asset divided by the 10-year lease term, and an interest expense of $20,076, which is our initial lease liability reduced with that first $50,000 payment, multiplied using your 5.87%. The journal entry that will be recorded is debiting and crediting your amortization and accumulated amortization for using your ROU asset, and we will recognize our interest expense and increase our lease liability with $20,076. The amortization table of the finance lease shows that the ending balance of the lease liability and ROU asset is different because the upfront payment that was made and the interest incurred on the lease liability. Next, we will look at the example fact pattern with the assumption that it is an operating lease. The amortization schedule for the operating lease indicates that a lease payment will be made on a straight line basis, $50,000 per year, totaling $500,000 over a 10-year period. The lease liability and ROU asset is recorded at the present value and is amortized annually. If you can remember that the $50,000 was paid at inception, so at the end of year 1, we will have to recognize the lease expense. The ROU asset is decreased for the amortization of the asset, and an interest expense is recognized, which will increase your lease liability. In year 2, we will again recognize our lease expense, amortization for the right of use of the asset, and we'll increase our lease liability for the interest incurred. Then we will also reflect the $50,000 cash payment, which is due at the beginning of year 2, and this offsets our lease liability. The amortization schedule of the operating lease shows the ending balance of the lease liability and the ROU asset, which is the same since there are no direct costs, variable costs, or anything that may cause the liability or the ROU asset to be different. Here we have an illustrative example of what your balance sheet would look like. You would recognize your finance lease ROU asset, net of your accumulated amortization, and your operating lease ROU asset under PPE, and you'll recognize your current and non-current finance lease and operating lease liabilities. Looking at the implementation approach, a modified retrospective approach is required, which calls for the lessee recognizing and measuring leases at the beginning of the earliest period presented. Note there are some practical expedients which allows for some exceptions. The new standard also requires additional disclosures to help financial statement users understand the amount, the timing, and uncertainty of cash flows related to your leases. Lessees must also report qualitative and quantitative information, including information about variable lease payments and options to renew your leases. Leases on buildings as well as copy and phone systems are commonplace for not-for-profit organizations. Each organization should review and update their internal controls to ensure their processes effectively identify operating leases and that their accounting policies and practices appropriately report these leases under the new reporting requirements of this ASU. Steps that we recommend you to take towards implementation are to firstly contact your CPA as soon as possible to discuss the impact of this ASU on your leases, to then take an inventory of your leases and determine the classifications, followed by updating your internal controls and processes and ensuring that the accounting policies and practices appropriately reflect your leases. And lastly, consider the financial statement impact of the new leasing standard and the impact the new assets and liabilities will have on your debt covenants. That concludes the leases topic. I will now hand over back to Carrie.
Thanks, Siobhan. So we know that leases can be quite complex. That was a very basic example of how this would be implemented. Depending on the number of leases you have and the complexities within the agreement, those calculations may be more significant and complex. And like Siobhan said, we just recommend you taking a look at what you have on for your organization, what leases you have, and also working with your CPA if you're needing help implementing that new guidance. So next, we're going to discuss revenue recognition for nonprofit organizations. First, we're going to talk about the difference between contributions and exchange transactions. It's imperative to properly classify all revenue streams appropriately to ensure the right revenue recognition standards are followed. The determination between contributions and exchange transactions is the first step in this process. Contributions follow the nonprofit industry specific guidance, which is located in FASB ASC topic 958-605, whereas exchange revenues follow FASB ASC 606, which is generally the rest of the revenue guidance used by for-profit organizations. There's some common exchange revenue that happens within nonprofits that includes things like tuition, room and board, and service fees, including service fees for patient care, membership dues, etc. Grants can be tricky. Remember that grants can be either contributions or exchange transactions. The term grant is not actually defined in GAAP, so it's important to look to the underlying substance of any grant or contracts to ensure that you're classifying them appropriately. Why is this so important? It's important so that you can follow the right revenue recognition. So it's important to know what a contribution is and what an exchange transaction is. First, we'll talk about a contribution. So contribution is an unconditional transfer of assets. This means it's non-reciprocal. I'm giving you something and I'm not getting anything of any real value in return. So if I donate $100 to your organization, I'm not getting $100 worth of value back. You can contrast that to an exchange transaction, which is literally just the opposite, where it's reciprocal. It's a transfer of assets that is reciprocal and you're receiving commensurate value. So if I give you $100, you're giving me back either $100 of goods worth the same value or you're performing $100 worth of services. So it's really important that you understand the distinction between those two categories so that you can properly classify and recognize your revenue. This table here comes right from the nonprofit professional standards, and it's a helpful way to just use these indicators to determine whether something's an exchange transaction or contribution. Sometimes it's really straightforward, and sometimes it may be more complex. There's also cases in which a component might be a contribution component, and there might be a component that's an exchange transaction component. This is important because there's different revenue recognition principles and practices for each of those two categories. So for contributions, FASB GAAP requires that you measure contributions at their fair value, and they're recorded at the date the contribution is made or when the promise is made to make the contribution. Revenue is recognized at that point in time, and there generally isn't any sort of deferred revenue when you're talking about unconditional contributions. Contrast that with exchange transactions. Exchange transactions are required to follow the 5-step recognition model that's part of ASC Topic 606, revenue from contracts with customers. So revenue is earned and recorded as or when each performance obligation is satisfied. And the revenue from exchange transactions can result in deferred revenue, like a deferred revenue liability, whereas that does not happen with contributions. We'll go through the 5-step process for revenue under contracts with customers in just a bit. But first, I wanted to show you this decision tree because this can be a very helpful tool in determining the different types of revenue for your organization. So this comes right from the FASB, and this decision tree, you can see the very first step is, does the transaction result in each party receiving commensurate value? So am I getting the same value back that I'm giving you? If the answer is no, then you follow through the rest of that decision tree to determine what type of, if it's a contribution or if it's some other sort of revenue. If there is commensurate value received, then that's when it's going to be considered an exchange transaction, and you have to follow ASC Topic 606 and use the 5-step model to recognize revenue. Let's run through that. Let's assume that we have a transaction, and this follows, it's going to follow 606. So the 5-step model for revenue recognition is as follows. The first step is to identify if a contract exists. So what this means is, does a transaction have true economic substance? It doesn't have to be an actual written contract. It can be an implied contract, but there has to be substance to the transaction itself. Once you've done that, then you must identify the performance obligation or obligations in the contract, whether implied or written. The performance obligations have to be distinct and identifiable. Next, you determine the overall transaction price, and then you allocate that transaction price to the various performance obligations in the contract. Once you've done that, then you recognize revenue when or as those performance obligations are satisfied. ASC 606 has 2 different points in time or points of recognition. So you can recognize revenue over time or at a point in time, depending on if certain criteria are met. So revenue is recognized over time if any of the following are met. The customer simultaneously receives and consumes the benefits provided, or the entity's performance creates or enhances an asset that the customer controls, or that the entity's performance does not create an asset with an alternative use to that entity that's providing the services. If none of those are met, then that defaults to recognizing the revenue at a point in time. Go back to our decision tree here. So again, you start with, did we receive commensurate value? If it's yes, you go through that 5-step process we just discussed. If the answer is no, then you're going to move to the contribution guidance. So let's walk through revenue recognition for non-reciprocal contribution. If you decide that it's a contribution, there's another step that must be determined, and that is whether or not the contribution is conditional or unconditional. And it's really important to understand that conditions are different than restrictions, which we'll talk through. But let's talk through when a condition is in effect and what that means. So an entity determines whether a contribution is conditional on the basis of whether the agreement includes both of these items. One, a barrier that must be overcome before the recipient is entitled to the assets, and there has to either be a right of return of the assets or right of rescission to not pay the amount agreed upon. So if both of those are in place, then the contribution falls under what is considered a conditional contribution. This is all based on facts and circumstances of the agreement or the scenario that you're looking at. It's not just a black and white situation. So some indicators of barriers include a performance-related barrier. That's one of the most obvious items, which is something like you don't get any of the funds until you perform a certain number of things. So you have to maybe serve 1,000 people, and then you get the money. That's a barrier. You have to first serve the 1,000 people before you get the revenue. Another example of this that's common is a matching component. So you don't get the revenue until you match that with other funds. So that's an uncertain future event, a barrier that has to be overcome before you can get the revenue. Some other items that can be barriers include limited discretion on how you conduct the activity, and then also whether there's stipulations in the agreement of how you what rules you follow, regulations. Those can be a little bit harder to distinguish. The measurable performance barriers are very common and should be reviewed. One of the items that was clearly identified as not being considered a barrier is administrative tasks. And they specifically said any sort of reporting is not considered a true barrier. So if the agreement calls for, let's say, an annual report or a progress report every quarter, that's specifically not considered a barrier in the new guidance. And so if that was the only barrier that you pointed out in the agreement, then this would not be considered conditional, it would be unconditional. So unconditional contributions are recognized in the period when they are received or promised and recorded at fair value. And as I mentioned, these may be considered donor restriction for a future purpose or future period. On the other hand, conditional contributions are no revenue is recognized until the conditions are met. So essentially when they become no longer conditional, at which point they're recognized at fair value. If funds are received in advance of conditions being met, and you've figured that this is a conditional contribution, then any funds received in advance are recorded as a liability. It's similar to deferred revenue. The specific name that it's given is refundable advance, but there are situations where you might get an advance under a conditional contribution, so you could have a liability. So in all of this process, it's really important to distinguish between a condition and a donor restriction, because as we all know, donor restrictions are very common in the nonprofit space. So a donor restriction limits the use of the contribution typically to a specific activity or a specific time, but doesn't place limitations on how the activity is performed. And it also doesn't have any impact on when revenue is recognized or when you're entitled to the asset. Contrast that with a condition, which we said includes a barrier that must be overcome before you have rights to the asset and a right of return. So those are the differences between a donor restriction and a condition. So moving on our little decision tree here, let's assume we have determined that the contribution is unconditional. So then the last step is to look at those donor restrictions. So revenue with donor restrictions is still all recognized as revenue. However, the amounts are tracked as net assets with donor restrictions on the statement of financial position, and those stay in net assets with donor restrictions until the restriction is met or satisfied, at which point those assets are released from net assets with donor restriction to net assets without donor restriction. And that release happens on the statement of activities and also is reflected in the ending balances of your net assets in the statement of financial position. So there's a lot of components to revenue recognition. I know that was a high-level review. Hopefully you can go through and look at those different flow charts, and that will help you determine the right path to follow when recognizing revenue for your nonprofit organization. Next, Matt's going to walk us through the contributions of non-financial assets.
All right, thank you, Carrie. So yeah, I'm going to go through implementing the new Gifts in Kind standard ASU 2020-07. So one of the most important things to start with is, what is a non-financial asset? Non-financial assets include fixed assets such as land, buildings, equipment. It can also include the use of those fixed assets or utilities, materials such as food, clothing, pharmaceuticals. It includes intangible assets, certain services, as well as unconditional promises for those assets. An example of that would be a lease. Let's say you've signed a 10-year lease agreement and you're getting that for significantly below market value. You would record that below market value portion as a in-kind contribution. These contributions are also known as gifts in-kind donations, donations of non-cash goods and services. So keep in mind that recognition of gifts in kinds did not change with ASU 2020-07. It's more that they just added disclosures. And there's 3 different main types of in-kind donations. There's donated goods, which are recognized at fair market value at the date of donation. There's donated use of facilities, which are recognized at the fair market value of the foregone rent at the date of donation. And there's donated services, which are recognized at the fair market value at the date the service is rendered, assuming it meets the certain criteria. And what are those criteria? Well, the donated service is only recognized if it creates or enhances a non-financial asset, if it would typically be purchased if not donated, requires specialized skills, and is performed by an individual that possesses those skills. So for example, let's say you run a healthcare clinic and a doctor donates their time to see patients at your clinic. That's recognizable. Now, if that same doctor is, checking tickets at a fundraiser event, they're not using their specialized skills, so that would not be recognizable. Other examples of specialized skills include legal services, accounting services, architect, carpenters, teachers. But keep in mind, general office work or similar services performed by volunteers are not allowed to be recognized in the financial statements, although you can disclose them in the notes. And ASU 2020-07 does encourage nonprofits to disclose this, but once again, it does not require you to disclose this. ASU 2020-07 is effective for annual reporting periods commencing after June 15th, 2021, which is now, and it needs to be applied retrospectively in all periods presented in your financial statements. The good news is, because this didn't change how these are recognized in your financials, hopefully this should be easy to implement, because all you're doing is adding additional disclosures. The main provisions are, once again, no changes to recognition or management of these items, but you do need to present contributed non-financial assets as a separate line item in the statement of activities that's separate from contributions of cash and other financial assets. And there are new disclosure requirements for each category of non-financial asset, and new disclosure requirements for contributed services that are not recognized. But just keep in mind that last one you only have to do if you decide to disclose these non-recognized contributed services. And so what do you got to disclose? Well, qualitative information on whether the non-financial assets contributions were monetized or actually utilized during the reporting period. Your policy, if you have one, for monetizing rather than utilizing contributed non-financial assets. A description of any donor-imposed restrictions that are associated with the contributed non-financial assets, and a description of the valuation techniques and inputs used to arrive at the fair value measurement in accordance with topic 820, and the principal market used to arrive at fair value measurement if it is a market in which the recipient not-for-profit is prohibited by a donor-imposed restriction from selling or using the contributed non-financial asset. So what does that bottom word salad mean? Well, let's say, for example, that you're a Eugene-based nonprofit that provides medical service not only locally, but also in South America. And you get a large donation of pharmaceuticals, but the donor says you can only use that in your South America operations. If you decide that you're going to value those pharmaceuticals at the US prices instead of the South America prices, you would need to disclose that. That's basically what that's getting at, is if you're using your donations in a different area than where you receive them, you need to donate. You just need to disclose that you're doing that. Contributed services that are not recognized are encouraged but not required to be disclosed at the fair value of the contributed but not recognized services. Required disclosures of information on programs or activities for which those non-recognized services were used, and you're required to disclose the nature and extent of contributed services that are not recognized. So the steps for implementing this, just start by taking an inventory of what contributions your organization is receiving. And then go and talk to other people in your organization. If you have a development department, talk to them. See if they're getting discounts on things or samples or just receiving things that you don't know about. And then consider the financial statement impact of these donations. Like, what is it actually going to look like? What's it going to do? And then evaluate the presentation in the statement of activities. Decide how you want it to look, how much you're going to break it out. And last but not least, actually draft a footnotes disclosing your in-kind contributions. Next, I'm just going to go through some examples of what this could look like. If you didn't know, we have a copy of the handout that has these slides, so you can come back and take a look at these examples. And in this case, you can just see, instead of contributions being on one line, it's now broken out between contributions of cash and other financial assets and contributions of non-financial assets. If you want to break these out more, like you want to give more details about the different types of non-financial assets you got, you can do that, but just keep materiality in mind, right? Like in this case, you have 1.8 million in donations. If you have $10 in some non-financial asset donation, probably don't need to separately state that. Here's an example of what the note could look like. You're just breaking it down more than the categories if you didn't want to do it on the face, where you're just saying, you get medical equipment, supplies, auction items, rent, nursing services. Just keep in mind that this total contributed non-financial assets needs to match that line in your statement of activities. This next example, it's really wordy, so I'm not going to read through it. But if you just want to look at this example, if you want to be more verbal about describing, what you're getting the goods for and what they're used for, you can write these paragraphs out. And they don't have to be this wordy. If we look at the next set of examples, there's some pretty short sentences. They can be short and sweet. And because sometimes some of the donations you receive are simple, there's not a whole lot of effort that goes into coming up with a fair market value. So if it's simple, that's fine. Keep it short and sweet. Another example here of just, how you can disclose the different in-kind contributions you get, really it depends on what's the big part for your organization, right? Like if you're getting mostly donated services, obviously you're going to focus more on that. If you're getting donated assets, just what makes sense for your organization to disclose. Here's another example of how you can break it out using a tabular format, breaking it out by the donated spaces, donated services, donated goods. This is a good way to do it if, your different programs receive a lot of different types of in-kind contributions, composed to like maybe you only receive donated services for one program and donated goods for another. So this is another good example of that. And if you want to just go like full table, this is a great example of how to do that. It's very clear in this example, like how much revenue each category got, what programs it was used in, what are the donor restrictions, and then how did you actually get those valuation numbers. So next, I'm going to kind of just quickly touch base on some older ASU updates. These have all been in effect for a while now, and I'm mostly just going to focus on them top level and kind of go over some of the struggles or issues we've seen as clients have adopted these. So the first one is net assets. Net assets is now required to be classified in only two categories: without donor restriction or with donor restriction. The major change here is before there was permanent and temporary restrictions, and now it's just either it has donor restrictions or it doesn't. And the main issue we saw that organizations had issues with is realizing that board designations are not donor restrictions. And that's because the board can change their mind at any time. So if you do have board designated funds, those need to be included in the without donor restrictions section. Contributions with donor imposed restrictions must be recognized and tracked as restricted revenue. Those restrictions could be purpose use, they could be based on time, and they can still be temporary or perpetual in nature. It's just they're not separately disclosed on the face like that. When restrictions are met or satisfied, net assets with donor restrictions are released to net assets without donor restricted, and they're reported on the statement of activities as net assets released from restriction. You can elect to record restricted contributions where you meet the restriction in the same reporting period as contributions without donor restriction. And all you have to do is just disclose that you're doing it and make sure that you're following that policy consistently. The next section I'm going to talk about is restricted cash. These are amounts generally described as restricted cash and restricted cash equivalents, and they must be included with cash and cash equivalents when reconciling the beginning of period and end of period total amounts shown on the statement of cash flows. The required disclosures, you just need to describe what is included in your total cash, cash equivalents, and restricted cash. And what does that look like? Well, usually something like this, where you got your cash, your different types of restricted cash, and then that total that matches the total cash and restricted cash reserves is shown in the statement of cash flows. Restricted cash is not super common for nonprofits. So the example I'm going to give you is one that you're probably more personally familiar with, and that's a mortgage escrow account. If you have a mortgage, it's really common for mortgage companies to require that you put in additional money with every payment, and that money goes into an escrow account. You own that escrow account, it's your money, but it's restricted to be used for property taxes and or homeowners insurance. So that's what restricted cash looks like. Money that is specifically set aside for another purpose. The other ASU update I'm going to talk about is liquidity and availability of resources. The following information is required on the face of the statement of financial position or in the notes. Usually we see it in the notes. And it needs to include relevant information about the nature and amount of limitations on the use of cash and cash equivalents, any contractual limitations on the use of those assets, as well as quantitative information and additional qualitative information as necessary about the availability of your financial assets at the balance sheet date to meet cash needs within 1 year from the balance sheet date. Key components that are required to be disclosure is, your disclosure of any access to liquid assets you have, if there's any restricted limitations on the use of your liquid assets, and your organization's goal for liquidity that, to ensure that you can meet your needs in the next year. And so here's an example of what that looks like. You got some qualitative information on there at the top, and then, actually numbers of this is how much cash we have. This is our, current accounts receivable, but donors have said we can, 38,000 of it is restricted for use. So we're not including that. And you would just back it out like this. Next example, pretty similar. It goes into a little more detail of like why you can't use those assets. And in this case, it's because some of it's part of an endowment, or most of it is just restricted to certain purposes. But there's ways you can break it out. It really just depends on what you think is more useful to the readers of your financial statements. The other section I'm going to talk about is functional expenses. It's required analysis of expenses by function and nature in one location. It can be in the face of the statement of activities or in the notes, but almost every organization I've seen has a separate statement of functional expenses. And it's required to provide qualitative disclosures about methods used to allocate costs among programs and support functions. And so how are allocations disclosed? Well, it's either it's direct identified, it's a cost that can be directly identified and charged to a program. For example, if you need to drive to, complete your program activities, that would be a direct cost, or it can be allocated. And your allocated method, should be rational and systematic, whether that's like time records, percentage of use space. It needs to be disclosed in the notes, and really important, it really needs to be reviewed periodically, especially when there's major events like COVID. Like, how many of the organizations out there had people start working from home? There's some major changes, and because of that, you really need to update your allocations because maybe before you were saying, well, 20% of our office building is used by the admin, so we're going to allocate 20% of the cost to admin. Well, if most of your admin team works remotely now, does that really make sense anymore? You really need to be evaluating these, like I said, especially when there's major events like COVID that really change how your organization is running. And common errors we've seen with a functional expense is, just putting stuff in wrong categories. It was also a big issue where people were reporting line items that were actually functional classifications. Fundraising was a big one on that, where there would just be a row called fundraising, and well, it doesn't quite work like that. It's also important to, hit a good mix between too much detail and not enough detail. For example, it's okay to have a $10,000 miscellaneous expense row if you have $10 million in total expenses. But if you only have 100,000 in total expenses, you really should break out that 10,000. Give the users of the financial statements more details about what that 10,000 actually is. Another issue that we found a lot was ignoring joint costs. So a lot of you will have, events that you put on where you talk about, what your organization's doing, like, some of the success stories you have, and those are great. But keep in mind, if you ask for money at all during those, then it's a joint cost, right? Like, you need to allocate some of those costs to fundraising because they're not fully program expenses anymore. All right, and next we're going to go into our Q&A segment.
Great, thank you, Matt, and thank you to all of our presenters. Very well done. So we do have a few questions in. The first question is, are there charts of sample services and associated costs for services donated that are not recognized? So I take that to be asking, is there a way to help value things that are donated services that wouldn't necessarily be reported?
Yeah, so there are organizations out there that publish lists, whether that's value for goods or services. So you can go and look up these numbers from third parties, and that's the better way to do it, is to take a third party. Don't completely come it up with your own, right? It's always a good idea to get a third party opinion on it, and there's pretty common to find those lists out there.
Perfect. Thank you, Matt. Got a couple more questions here. So the new leasing standard, it sounds like all leases are now showing up on the statement of financial position. Are there any circumstances where a lease would not be included on the statement of financial position?
Yes, so if the lease has a term of less than 12 months, you do have the option to just expense that over the lease term, and that won't be reflected on your statement of financial position.
You should have an accounting policy in that case. So it is important, if that's your intention, to not capitalize or put on your balance sheet those leases under 12 months, that you get that into your written accounting policies.
Perfect. All right, we have a couple more here. So our organization is on the June 30th year end. Is the new leasing standard in effect now for us?
It'll be June 30, 23 year end. So it's in effect because your fiscal year started 7/1/22, but you have, until June when you actually have to fix your financial statement. So this is good timing to start going through that process of looking at all your leases and starting to compile the data to run those amortization schedules and start getting that information put together for implementation.
And for the handful of our 12/31 year ends out there, 2022 is your effective year. So definitely something to be thinking about now.
Less time, a little less time to get those together.
All right, we've got one more question here. Do the new standards on gift in kind impact how they are recorded, or only the presentation on the statements and new enhanced disclosure notes?
It's only new disclosures. It does not change how they're recognized. And if you feel like you are having to change how you recognize them, probably weren't doing it right before.
I would be really careful about the disclosure because there are some significant additions to the disclosures, including how you came up with fair value. You're supposed to include that in the disclosures. So you don't just simply say it's presented at fair value. You're supposed to say how you came up with that, like what inputs were used to determine the fair value. And then also the disclosure about monetization versus utilization is kind of new. It's not something I saw frequently in financial statements before this new standard. And so what that means is, are you getting something donated to you and then selling it and using the proceeds? That would be monetization. And what's your policy for that? Versus you're getting something and actually using it within your program. So that is another kind of caveat and additional disclosure to be really mindful of as you go through.
All right, well, that's addressed all of our questions. As a reminder, if you have questions that come up later or a little bit more specific, feel free to reach out with those.
I'd like to thank everybody for coming today. We ended early, so you all have an extra 40 minutes to work for your day or leave early. It's a Friday. So I hope everybody found the information useful. And again, reach out to us with any questions. And I hope you all have a great weekend.
Bye, everyone.
Thank you.